Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're talking about red flags. I'm going to be going through 5 big reasons that an options trader might decide to just skip on a trade, even if they think they have a great trade idea. So should be a really interesting discussion. We'll talk about what some things may register as red flags and the sorts of steps that a trader might take to bypass those where possible. I think it's an important discussion. Before we can get to that, though, let me first of all say hello to everybody who's joining. Great to see all the familiar names, as always. Hello there, Bill and Hamlet and Elaine, E. Dunny, Ricebird, Croatoa, Jay Richardson, Paul, Eva, everybody else. Thanks for joining us week after week. I always do appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's always a great way to watch these webcasts. But be aware that you're invited to join us in the live stream if you'd like to be here in our audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my very good friend Mike Fairborn is hanging out in the chats with us today. He's going to be keeping an eye on any questions that come in. If I can't get to those questions, Mike's there to help me sort of pick up the slack. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation for everyone to follow us on social media. You really should be following your favorite Schwab presenters out there on social media. It's the best place to connect with us in between the live streams. You can find Mike and me on X. So you can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. Now, you can also, as of recently, find and follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this important discussion of the sorts of things that might cause a trader to just pass on what seems like maybe a good option strategy idea. So let's, as we consider these risks, let's also bear in mind that risk is real. This is important information. So bear these important disclosures in mind. Equity and index options carry a high level of risk and are not suitable for all investors. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risks, including the loss of principal. All right, so with all that said, let's set an agenda for today's discussion. I want to propose just an example option strategy idea that a trader might have. So we're going to take a look at a trade scenario where traders might be considering getting into a new option trade. But then I'm going to talk about 5 things that might cause that trader to pause on that idea. So we're going to talk through those 5 elements, 5 big reasons that a trader might skip a trade. And then by the end of today's discussion, we'll just plan and place a trade on a different security that maybe doesn't have any or some or all of those sort of red flag scenarios. So let's get into this. Let's bring up our example trade here. So we're going to kick things off with a discussion of Garmin. So trading symbol is GRMN. Let's say that our would-be options trader here has noted that Garmin has been bouncing along for a couple of weeks now, just above that $200 level. Maybe they expect, could be prices are set, it looks like prices are coming up off of that support level again. And so they strike upon the idea, ooh, what if I were to set up a 190, 195 bull call spread? It's an option strategy. If you're not familiar with it, for this trade to work out optimally, really what the trader would be looking for is for the stock to just stay above 195. And let's say that they set the expiration for that trade for March 20th. That's the third Friday expiration in March. Probably, well, actually, I'm going to back away from what I was about to say because it'd be kind of a spoiler. In any case, so that's our trade idea. And if we're looking at this chart, maybe there could be some evidence that this might not be a bad idea if the stock continues in the direction that the trader is intending, or even if it can just stay above 200. At worst, even if it stays above 195, that trade could still work out optimally well. That's how a bull call spread works, is to stay or to be above the spread as we approach the expiration date of the trade time frame. So let's talk about what might be red flags. Red flag number one. If anybody's been following Garmin, you may know, even though it's not obvious here, there's an earnings announcement right around the corner. Now, not every trader, I'm going to say this, that for each of these potential red flags, not every trader is going to see them as red flags. For others, they might be totally comfortable with these things. But here we have a stock that seems to be behaving as the trader might hope, but there's something that might come along, throw a big wrench in the works in the form of a big news announcement. So how is it that we could avoid being blindsided by something like an earnings announcement just with a change to our chart configuration? Let me come up here to our chart settings. I'm going to click on the little gear icon. I'm going to go to equities, since Garmin is an equity or a stock. And I'm going to check the box right here that says show corporate actions. If you're not familiar with what a corporate action is, it's an action that a corporation might take that could influence its stock price, including like stock splits, but also things like earnings. So I'm going to check that box, click apply, and click OK. And then Thinkorswim applies a very handy little icon here, a red telephone and a blue light bulb. That's an indication that there's an earnings announcement coming up. And you can see February 18th, this is before market, there is an earnings announcement on the calendar. Now that earnings could go well, or it could go poorly. Let's look at the last earnings announcement. Maybe this will highlight the kind of risk that might be taken on a trade such as this if the earnings is not well received by shareholders. Now, this is not a guarantee that this is how this earnings is going to go, but for some traders, they prefer to sidestep things like that. So a quick way to identify an approaching earnings announcement is to turn on that show corporate actions function on the chart. Now, even if we do that, if there's not space to see that on the chart, then we may still not make a note of an approaching earnings announcement. So a second adjustment we might make is to change what we call our right expansion settings, because by default, this candlestick that's furthest to the right is going to be crowded right up against the right side margin. There'll be no extra space on our chart. That's known as the right expansion setting. And by default, there is no expansion. So we can come down here to this double-headed arrow icon and change that right expansion from 0. Let me show you what that looks like. Let me click apply. Notice now we can't see any approaching earnings. We can't look out to that March expiration. Let's maybe this open up to 10 or 20 or 30 trading sessions, known as bars. Okay, so we'll change that to bars. Click apply, click OK. Now we have that extra space. Now, earnings are not the only news announcements that can come in to throw a wrench into the works of a carefully planned options trade. They're not the only news announcement. There can be other things like scheduled economic announcements. So we can check on those right here on Thinkorswim. If we go up to Market Watch and we bring up the calendar, so we go to the Market Watch tab. Let me go back to charts, and as I hover over Market Watch, you'll see calendar here. So I'm going to select the calendar, and by default, it might be showing lots of potential events. So if I want to see, for example, let's uncheck show all. If I just want to see approaching earnings, I can see that here. And if I were to advance the calendar to next week, I would actually see our Garmin earnings announcement. Another thing that a trader might keep an eye on are something known as Econo Day events. And these are events, let me just take off this requirement here, not just the S&P 500. But an Econo Day event are things like consumer price index, producer price index, things that show up on the calendar that may influence the markets in one direction or the other. We never know exactly how much or in which direction an announcement might influence the markets, but at least here we could check to see, we could see if make sure the trader's not getting blindsided. So for example, I can see just on Thursday, the 19th, we have CPI. We have PPI on Tuesday, the 17th. We also have a GDP announcement on Friday, the 20th. So there are two takeaways from this. Number one is we can check to see what the economic news might be on the immediate horizon. And then if the would-be trader wants to investigate to see if their a stock has particular sensitivity to a given announcement, they can do some quick research. But another thing is, we can't avoid every announcement. So if there are maybe a few highlight events they prefer not to trade through, or a few highlight events that might cause them to stay away from certain stocks in certain sectors, I think that could make sense. But if we're avoiding all stocks because of any economic announcement, we might just be on the sidelines and never trade. So there we go. Big reason number one that some traders might choose to pass on a trade are big news announcements that are on the immediate horizon. Let's go back to our chart and explore big reason number two. Now, Garmin is a big company. It's actually an S&P 500 company, but in the world of options trading, liquidity can be a big concern. If a stock's options are not liquid, it can make it difficult to get into positions and to get out of those, especially if they're what we call multi-leg strategies. In this case, we have two different options that are being traded, the 190 and the 195 calls. So if there's stickiness trying to get into or out of these trades, it can make it difficult. So liquidity, or the lack thereof, if we have an illiquid option, it might cause a trader to say, you know what, this was maybe a good idea, but it's not a good idea for this stock. So let's look at that. How might we see hallmarks of liquidity, relatively speaking, from one stock to another? What is good and what is bad? Well, just the volume of trading on the stock itself might be an indication of how liquid its options are. Illiquid stocks tend to have even worse liquidity with their options, and there can be that stickiness trying to get in and out of positions efficiently. So a first element might be to just check to see, is it a great big company with lots of trading volume? Well, Garmin actually is one of the bigger companies out there. As I mentioned, it's an S&P 500 company. So let's dig a little bit deeper into liquidity. What are some of the indications of liquidity for those of you who are a little bit more veteran with options trader? What are some other indications of liquidity that you might check just as a little checklist before entering into a trade? Let me go to the trade tab. A second thing that the trader might check, let's come here. I'm going to switch up our column display on our option chain. Right now I'm seeing our Greeks, delta, gamma, theta, and vega, which can have their uses, certainly, in the planning of and placing of an options trade. But I'm going to come right up here to where we select our column headings, and let's change this to volume and open interest. Yeah, Lola just said open interest. Yep. So what in the world are volume and open interest? Well, volume is how many contracts have traded at a specific strike on a given day. So how about we look at the strikes that we were looking at here? So 190 and 195 calls on the left side. Well, there's been exactly zero volume so far today. I'm looking at the open interest. Look at that. Anyway, let's look over here at the volume. No volume at the 190 strike. No volume at the 195 strike. And what is the open interest? So volume is how much trading has happened today. Open interest is how many contracts or how many active contracts there are, or open contracts at a specific strike price. So at that 190 strike, there are no other traders who are currently in positions on the 190 Garmin contracts for the 20th of March. Does that sound like a terribly liquid market? Probably isn't. At the 195 strike, 5. A grand total of all the traders out there, 5 open contracts at that strike price. Now, for some traders, they may have minimums that they like to see here. They may say, for example, they might look at that open interest, and if however many contracts they're planning on trading for their trade, maybe they like to see a multiple of, let's say, 20 times that number in the open interest. In other words, maybe that trader prefers to not represent more than 5% of the open contracts at a given strike. So if we were to, let's say we did one contract at the 195 strike, that would mean we'd be one of 6, or just the trader here would represent just under 20% of the open contracts of the 195, and they would be the entire open market at the 190. So there are a couple of indications of liquidity. So the underlying securities liquidity, is there a lot of volume trading on the stock itself? Open interest and volume. But all of these ultimately point to one bottom line number, and that is the spread between the bid price and the ask price. So when a trader is buying options, they typically pay somewhere near the ask price. When they're selling options, they typically receive as a premium somewhere near the bid price. Now, not always, but generally that's fairly accurate. When we're buying something, we ask how much somebody's asking for it, and then we pay their ask price. And if we want to sell something, we sell to the highest bidder. That's a way to think about that. But if there is a big difference between those two prices, it can be a very strong sign that there is a lack of liquidity at a specific strike price. So another way to put this is if I were to buy the 195 call, let's just say we just bought it. We're bullish on the stock, let's buy the call. So we buy the 195 call and we pay close to $21 per share. That's a $2,100 investment. And then let's say that trader has immediate buyer's remorse and they go back to sell that call. Stock price hasn't moved, no time decay has happened. They just have immediate buyer's remorse, so they go back and they sell that call they just paid $2,100 for. How much is on offer as a potential premium to sell that for? We might have to sell it for $1,870. That's a big drop. That's a it's $2.30 per share. That's $230 of slippage. That difference between the bid price and the ask price. And that's due in a large part to poor liquidity on that strike price. So let me see. Jim has a question here. How can I change the color in the options chain for in the money versus out of the money? Yours is hard to see. So Jim, yeah, mine is just yellow and white, which isn't terribly high contrast. Switching to the dark background, just right up here. You may do that. Just go to look and feel and change this color scheme from light to dark. But yeah, I can relate to that. Now, color scheme is nice. It's also just nice to thoroughly understand what in the money and out of the money is. And I think you do. But that's just another heads up for anybody else watching this webcast in the future. Let's see. I see another observation. Volume. Okay. In any case, oh, somebody's saying, look at this. Yeah. 788 volume at the 240 strike. So what's going on there? Well, it may have been just the closing of a great big single position. Could be a multi-leg strategy. The volume and the open interest don't actually give us a lot of insight into what other traders are doing. It's just an indication of general activity, buying and selling at certain levels. Okay, so liquidity is another concern. And obviously, if there's a wide spread between the bid price and the ask price, we can see how that can be a disadvantage. If our intention is to buy one call and maybe sell it later, that could be a problem. Or we're at the same time selling another call and we might have to buy it later. It can be disadvantageous disadvantageous in both directions on both legs of that spread. And that can cause some traders to just pump the brakes, say, nope, that's a big reason I'm going to pass on this one. So what might they do instead? Well, they might look for stocks with bid-ask spreads that are narrower. And as a rule of thumb, for some traders, they might use as like a general gauge. They may look at this ask price, and if the spread going down to the bid is more than, let's say, 5% or 10%, that can start to stretch the idea of good liquidity. Jim, clicking the high contrast fix it? Okay, I might have to explore that. There's always something new to learn on Thinkorswim, even for those that have been using it for a long time. There can be little questions that we ask ourselves and explore it and find nifty new little answers. So thanks for pointing that out. But let's move on to our third big reason a trader might choose to pass on a trade. So let's go back to our chart. Here's our strategy idea, which relies on the stock just staying, above 200, maybe above 195 as we move toward expiration, maybe the trader would prefer to not see the stock bouncing all over, giving us a racing heart rate every day as we're waiting for the next however many days. What would the length of this? It was 38 days. Yeah. If the next 38 days are full of choppiness, that can be a tough ride for some traders. And so expected higher volatility may cause some traders to pause. So how do we get a gauge for how much volatility is either expected for the markets at large, or maybe even specifically for Garmin itself? Well, that's where, let's go look at the VIX first of all. This is a gauge of market volatility. It's actually an extrapolation of expected market volatility basically over the next 30 days on the S&P 500. But if you're not familiar with the VIX, it's known as the CBOE, the Market Volatility Index. And when this is high relative to other times, it might mean that there are high expectations for volatility among options traders for the coming weeks than at other times. So when we see peaks like this, what the trader needs to be prepared for is they are stepping into relatively choppy waters. Now, when volatility peels back, expectations for volatility might be lower, and it might help the trader feel a little bit more confident that they're not getting in when other traders are convinced that things are set to be pretty choppy. Now, this is not a guarantee. Obviously, volatility can spike up unexpectedly at any time, but it might be used as a general gauge. So for our would-be trader here on our vertical spread at this moment, they might say, well, at least we're not seeing elevated levels of volatility like we have seen at points in the past. As of this moment, it's kind of average. If you'll notice, let me just sort of draw a line back here. So here's volatility levels. You can see we've had higher volatility at times. We've had lower volatility at times. It's kind of average. But for some traders, based on personal preference, they may decide to just hold off on new entries when volatility is particularly high. Okay, somebody just asked this question: how can I tell volume and open interest is bullish or not, regardless of put or call? That's tough to know. We could go have a look at like time and sales, but just open interest or just volume taken in isolation don't give us those insights. Let's say that we're looking at two different strike price and one has volume of 100 and the other one has volume of 10. Well, we might think, ooh, someone else knows something. Maybe they must be bullish about this or bear. No, we don't actually know. They might have bought a call. They might have sold calls. Both of those contribute to volume. They might have purchased a put. They might have sold a put. Both of those contribute to volume. So we don't have those insights from those numbers. And as a matter of fact, maybe there's 100 contracts of volume at one strike, and what we didn't notice is that at a different expiration, there was a matching 100 contracts at a different strike, and maybe it was a diagonal spread, maybe it was a vertical spread, maybe it was a calendar, maybe it was an iron condor. We don't know. All of those would have very different implications regarding what the other party is thinking. And by the way, maybe the other party doesn't really have any special insight. Anyway, we don't know. Okay. Anyway, there we go. It's a good question. Paul is suggesting maybe a put-call ratio if we start to see extremes like way more calls than puts being purchased. Maybe that indicates greater bullishness on the markets. But even just looking at the S&P's trend is probably going to give that sort of sentiment insight as well. And sentiment can change. Anyway, good question. I'm not being dismissive of it. I'm just clarifying what open interest and volume can tell us and what they actually can't. All right, next up. So we have three big reasons so far. News announcements, maybe the trader prefers to sidestep and wait until after. Liquidity, maybe we move onto a different security with stronger liquidity. Volatility, maybe we wait for calmer market conditions if that's the trader's preference. Well, one other thing I want to talk about with volatility that I didn't address is, let's go back to Garmin here. how can we see that same volatility metric, but specific for Garmin? Alex says, will you have a session on Bollinger Bands? I actually have, Alex. There's a good question. I don't mind addressing this just quickly. So in this webcast series, the focus is on options trading, not necessarily on charting. However, I do teach a webcast series. I deliver a series of webcasts every Friday. It's called Advanced Charting Techniques. Let me show you this. If we go to our Trader Talk channel, so if you're new to these webcasts, do yourself a favor, go down and click on the subscribe button down below the video. It only takes a second, doesn't cost anything. But our Trader Talks channel on YouTube is where you can, yes, join the live streams like we're having right now, or you can also find playlists of previous webcasts. So for my Getting Started with Options, but also for my Friday series that's called Advanced Charting Techniques. Now you can even do keyword searches. Let me do this. I haven't tried this yet. Let me type in my name. We're going to learn together. But you can do, let's say, Bollinger Band search. So I'm going to type in my name and then Bollinger and hit enter. And what do you know? Here's a combining 3 Bollinger Band studies into one trade system. Let's scroll down a little bit more. There's my face again. 3 example strategies for trading with Bollinger Bands. Beginner's Guide to Trading Stocks with Bollinger Bands. So will I have a session on Bollinger Bands? Alex, yes, I will in the future. I don't know when, but I've also done that in the past. There you go. You can go check those out. All right, so thanks for asking that question. But I threw out this question to you on Garmin. How can a trader gauge other traders' expectations for volatility on Garmin itself? There's actually a study for that. Let me go up here to our little flask icon, and I'm going to type in IMP for implied, and then VOL for volatility, and there's a study known as implied volatility. I'm going to add that to our chart, click apply and click OK, and what we see here now is this study that rises and falls on a sort of a horizontal axis. But basically, when this green line is up and relatively high compared to where it has been historically, that might mean that other traders' expectations for volatility are relatively peaked. They're pretty high as well. That's kind of interesting because look at where this is right now relative to where it has been over the last 9 months. This is the highest level. We're right near the highest levels of expected volatility that we've had in the last 9 months. You'll also notice that that can be strongly correlated to approaching earnings announcements. Those can introduce volatility. This may literally be a bit of a red flag for those traders who don't like to trade around earnings. They don't like to trade at highly elevated levels of volatility. This might help assist in identifying that. All right, so that's the implied volatility study. Let me just leave that. I'm going to leave that here on our chart. All right, but going back to our strategy idea, let's talk about potential red flag, big reason number 4 why some options traders might choose to skip a trade. And that is maybe they have concerns about other elements of the chart. When I first introduced this idea, it was based on the observation that the stock price had stayed above $200. Now, going back to that chart, maybe our traders, in their excitement, they were ready to go place a trade, and they say, wait a second, let me go look at the chart one more time. And they note, we've been coming off a price floor, but is it possible that we're also approaching a price ceiling? Could this, before that March expiration, bounce against that ceiling, get pushed right back down toward that floor, and maybe put that trade under threat again? That's a possibility. Lola says the higher level of volatility than average for Garmin, does that have anything to do with the wider bid-ask spreads? Oh, that's a good question. And the quick answer is yes, it can. I can't guarantee it, but yeah, when there is high volatility, for some traders that can cause them to sort of hit the pause button. And in advance of events like this, that volatility can introduce new risk for buyers and for sellers, and that can cause a widening of the spread. Yeah. So sometimes what we'll see is a widening of spreads before earnings as volatility levels are reaching a peak, and then after the earnings, volatility settles down and those spreads can narrow back up again. Yep, it's not always the pattern, but it's a fairly pronounced one with some stocks around those highly volatile times. So good question there, Lola. Anyway, but how many of you, when I first brought that up, your eyes already went to this? Let's be honest. Did any of you already have concerns about my observation about this chart? Now, this might not be an immediate concern because even if we bump our heads up here at, let's say, 215 and we pull back, as long as we're still above 195, theoretically, this trader's in good position come expiration. But for some, maybe it's enough to give pause, or it can just be other technical concerns. Now, another thing the trader might do is it might not be just price action. Maybe they have a favorite technical indicator and it doesn't look like it's in keeping with their intended trade. So for example, let's go up here and add like a simple moving average. Let's add this to our chart. This is sometimes used as a trend identifier in addition to potential levels of price floors and price ceilings. But let me just edit this. Let's say it's a longer term moving average the trader is tracking. Let me apply that to the chart. And so here we have price is currently going up, but it might have an obstacle in the form of a price resistance level. It may have an obstacle in the form of a descending trend line. Those are just a couple of examples for why a trader might say, wait a second, maybe this isn't looking as bright as I was thinking, and it might give pause. Now, I want to balance this discussion though, because I actually did a webcast recently, and I was reading through the comments on that webcast, and one of my viewers was actually highly put out. They were quite offended that my technical observation on the chart ignored their preferred indicator. And they said, Cameron, you have a crazy chart idea here because this other, X indicator, just to speak generically, was showing the opposite. And so you blew it, buddy. It was a big mistake. Well, no, there's some validity to that observation, but there's also some balance that I might encourage. And that is, if the trader wants to find something wrong with the chart, do you think they can find something wrong with that chart? If we want to talk ourselves out of a trade idea, if we're a talented enough technical trader, we can talk ourselves out of just about anything. That's a possibility. What do we call that? We call that analysis paralysis. And that is looking for perfect chart scenarios that show nothing wrong as far as we can tell. Ooh, that's the perfect trade candidate. Even if we go to that extent, and even if the trader finds what they think is the perfect technical scenario, even that doesn't guarantee success. So Lola says, yep, I talk myself out of trades all the time. This could be, for some, it might be an argument that maybe they need to simplify their approach if they're constantly running into barriers to advancing forward with trades. Risk is just part of the life of trading. We can't avoid risk. It can feel like adding more and more and more and more levels of complication and technical requirements is moving the needle toward less and less and less risk. It may not. It may just be causing the trader to be paralyzed by their analysis. So I would just urge caution with that as well. So there we go. There's an example with Garmin. But concern number 4 might just be they don't like something else that they see on the chart. That can be valid. All right. Now, finally, sometimes our emotions just get in the way. Emotions can work in both directions. Maybe we're just entirely fearful and we can't advance a trade. That can cause a trader to skip trades, and maybe sometimes to their detriment. But also overconfidence. Sometimes we think we found the perfect trade. Let me talk through this. I have a few points. I always make an outline of what I want to discuss in my webcasts. So I want to make sure that I'm thorough here. Have we ever felt like in planning a trade, ooh, this is the one. This is the big trade. I haven't seen a trade looking this good. for that reason, some traders have insight into themselves and they realize, wait a second, I need to pump the brakes because I'm getting tempted here to just go all in on a big position. And that's inconsistency from one trade to the next. So here's the problem with inconsistency. If we take a very large trade on one position, and then we take a little tiny trade on another one because we're just not as confident in that, all of our focus tends to go right to the big one, and we start to lose sleep. We maybe start to ignore our planned management rules because we're just watching, we're monitoring this thing tick by tick. So when we get really excited, this is the one style that might cause the trader to back off. That's just one expression of emotion. Another thing is if we just have a feeling of urgency. I got to get in, I got to find something. Maybe that's a time to just hit the pause button. The trader might recognize within themselves that this is emotions taking over, not a set of disciplined rules that I'm applying. Number three, within this category of just emotions, this number, I'm kind of conflating my numbers here. We're still talking about number 5, which is just emotions. But sometimes traders fall into what we call revenge trading, trying to make back what we lost on another trade, and we're just ignoring every other element of the trade. It's all of a sudden we know this is just not, it's no longer a good idea based on careful planning. It's just keep throwing money at it until hopefully it turns around. That's where emotions might have taken over. It's driven by the feeling of we need to be right. Risk is just real. Sometimes the trader just needs to recognize this one didn't go well. Time to move on to another one that looks like it might be a better idea. And so finally, how might we overcome emotional trading? The biggest deal might just be having a set of rules. Rules can provide structure when our emotions are not providing that structure. So does the trade meet our rules or not? And then go forward with that. So those are 5 big reasons why a trader might choose to skip a trade. So news, liquidity, volatility, chart concerns, and recognizing that one's emotions are playing potentially too large of a role. So that was fun. Let's quickly look at a different trade scenario. How about we look over here at Alphabet? So here's Alphabet. Maybe our trader here again sees price moving in a way that they think appears to be bullish. It looks like with Alphabet, instead of holding at $200, it's more recently been holding at about $310. Even today's candle, for those that study technical analysis, you might see that looks like a bit of a what we call a hammer candle. But in this case, more distance up to the trade seems to be closer to that price floor, further from the price ceiling. Conceptually, maybe more upside wiggle room. We're trading above this example technical indicator, that trend line. And down below, what's our implied volatility? What's the volatility scenario? Well, we're not at highly volatile peaks. Instead, in this case, it's more like our VIX scenario where it's sort of average. As a matter of fact, for Google, for Alphabet, expectations for volatility have only infrequently been lower than they are right now. Now, a final observation is that the earnings announcement is in the immediate rearview mirror. It's not going to be something that the trader might need to avoid as they're planning and placing a trade for March 20th. So maybe this is our example trade. How might the trader structure this trade? Well, if support appears to be at 310, maybe they set up an example trade below that. I'll just stay with the original premise, which is to do a bull call spread. So what if we were to look at maybe a 295-300 spread? Let me go see what that might be trading for. And as we do, let's check the liquidity. Let me ask you, Alphabet, what do you suspect? Is it going to be a liquid stock or not? One of the biggest companies in the world. Yep. Yeah, it's probably going to have quite good liquidity relative to lots of other securities. So as I go down here to the 20th of March contracts and I look at, let's say that 295 and that 300, notice, just as an example, the ask price of our 295 is $29.70 and the bid price is only 40 cents less than that. 40 cents is what? About 1.5% lower. That's a much narrower spread between the bid price and the ask price, a strong indication of liquidity. How about our open interest and our volume? Much higher than what we were seeing. Yeah, Zink says you never heard of Google. All right, so for our trade here, how would we structure this trade? Our bull call spread, buy the 295, sell the 300. Here's a little bonus. If you don't know what I'm talking about, a bull call spread, that could be big reason number 6 that a trader might not choose to go ahead with a trade. If we don't understand the strategy, it may be time to, again, pump the brakes, pause, learn the strategy, and then maybe reconsider entering it. But how about we place this trade? Let's go 295, 300. I'm going to go up to spread single. I'm going to change that to a vertical so I can come to 295 and 300. And we're just going to click on the ask price. And it looks like it might cost us, how about we're willing to spend up to $4 to get into this trade? Let's enter that as our limit. Let's click confirm and send. This would be buying 10 of these vertical spreads for $400 each. So it would be a $4,000 investment with a $1,000 reward potential. It is a high probability trade, which with vertical spread trading is associated with lower reward. You know, if we have a strong chance of being right, there's a smaller reward for being successful. Now with this trade, there is a commission to be paid. So we need to be aware of that. $13 total brings the total maximum that we'd be spending on this trade to $4,013. And we're going to send that order off. There we go. Looks like we bought that for $390. Okay. But guys, hope you enjoyed this discussion. I think it's important for new traders to be learning what are some of the more veteran traders looking for when they have a trade idea, what might cause them to back away from that idea. So we talked through 5 big reasons that a trader might just decide, I had what I thought was a good idea, I'm going to skip this one, move on to another one. So guys, if this is your first time in my Tuesday webcast series and getting started with options, it'd be great to have you here. I hope to see you again in a future webcast. You can check the archives for these things. But we've talked through the 5 big reasons a trader might choose to skip a trade. We've put that into context using an example trade scenario, and we've planned and placed a trade that seems to not have as many of those obstacles. Of course, the example trade we place is not guaranteed that it's going to work out perfectly. It certainly has its risks, so we have to be aware of that. But I'm going to let you go enjoy the rest of our webcast for the rest of the day. But as you do, just a full slate of educational resources available to you from Schwab Education, including the Trader Talks channel. Okay, so let me take us right back to the channel homepage. If you haven't subscribed to our Trader Talks channel just yet, pop down below the video, click on the subscribe button. Again, it only takes a second, doesn't cost anything, but this is where you can join our live streams. You can find our playlists here, and you can even do keyword searches like we did for our Bollinger Bands discussion earlier. If you want to find the playlist for this webcast series, you click on playlist and then look for Getting Started with Options. We have a lot of webcast series currently and historically, and you find those here. Mine is parked right down toward the bottom. So right down there, Getting Started with Options, we click on View Full Playlist, and that's where you can see the archives of, let's say, last week's webcast, the week before that, and so on. Now, another thing that Mike and I want you to be aware of is that you should be following your favorite Schwab presenters on social media. It is the place to connect with us in between the live streams. So you can find Mike and me on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. I'm very active here. And when you reply to one of my posts on X, I reply right back to you. As long as it's something not crazy political or I'm obviously not going to get into religion, those sorts of discussions. So, yep, I'm prudent on social media, but if it's on topic, if we can have just a nice discussion there. Now, you can also, as of very recently, follow me on LinkedIn. So here's my LinkedIn profile. you just go to linkedin.com/in and then /Cameron May CS, like you're seeing right here on your screen. Give me a follow here. I also post here, and if you reply to my posts here, I reply right back to you as well. Again, an opportunity for communication between the live streams. Everybody, thanks for your participation. Thanks for all the thumbs up. That definitely helps. I can see still 134 people watching the live stream, and we have 67. That's half. Thank you. It's exactly half. That is very much appreciated. It's kind of like a pat on the back to your presenter, but it also gives my webcast a boost in the YouTube algorithm, helps more people find these important discussions that we have, like 5 reasons why we might choose to pass on a trade. So everybody, go have a great day. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.